So we have still a great keynote before we go, and so it's my privilege to present Martin Houston. He accepts Houston in this town. He has the appropriate last name for the business, for sure. My name is Francisco Monaldi. I'm, as the ambassador said earlier today, I'm the new Latin American Energy Policy Fellow, and so we are going to be developing the agenda on the regional aspects of energy. Of course, as the topic of today, we will be focusing a lot on Mexico. There is a book coming on from the Mexico Center on energy and the rule of law in Mexico that we will be launching next year. And we have we're going to be pursuing those and other subjects in the next few months and years. So our speaker today has an amazing experience in the sector. He's currently the chairman of Parallax Energy, which he founded in 2014. But he has an unparalleled experience of 3 decades or more at the BG Group, in which he retired as the chief operating officer. So he has a tremendous experience on deployment of LNG and other natural gas infrastructure. He's also, since November 2014, joined Tudor Pickering Holt & Company as chairman of TPH International, where he's helping to create an integrated investment bank to expand his to expand his presence on global areas. And he's also a senior advisor of Pine Brook's Road Partners. So we are looking forward to his presentation, and then we will have some time for Q&A. Thank you.
Thank you, Francisco. Ambassador, ladies and gentlemen, it's a great privilege to be a speaker in this room. I've been a listener in this room many times, and I hope I can make some comments worthy of the room and its heritage. I also make a small apology. I'm not sure that I can see many overlaps, but I did do an after-dinner speech at the Rice ENC Forum on Monday night, and I do apologise if anybody was at that event too, because not much has changed in terms of the commodity markets, although with the volatility we have around us, who knows, it could have done. What I'm going to cover today are 4 things. I'm going to talk about the global context. I didn't catch much of this morning, but I was aware of what the topics were. And I think the global context, particularly as we look at energy, is important. So I'm going to, we live, to use the rather hackneyed expression, in interesting times. But with all the implications of this Chinese curse, because we live in times of danger and uncertainty, something that Robert Kennedy said a number of years ago, and yet the opportunities afforded to us by the sheer magnitude of the energy resources in North America can provide a great buffer to the global contagion, particularly in this region. Now, I'm going to say a little bit about oil price. I know Walker Moody, a colleague of mine at TPH, covered it this morning, but I'll say some because it's really at the root in the energy world of our fears and our concerns today. We think about it because of our companies, because of the people who work for us, our jobs, and secondly, because Houston itself is at the nexus, not only of the Mexican arc, which I saw in the last presentation, but also the center of the energy universe. And it's starting to bite. I mean, well, like it or not, people are losing their jobs. And real estate, which is a great indicator in this economy, is also starting to suffer. So we've got more sellers than buyers. And I guess, where have we heard that before? In our own energy business. I'm going to say then a few things about my perspectives on North American integration, though you've heard a lot this morning, but I'll try and put a macro picture together on it. And I must admit I've not been a student of NAFTA and the many tomes that back it up and have written about it over the last 21 years, or indeed what it implies or what it doesn't. But it's always been a curiosity to me with the varying views. And just pulling down some things off quotations.com. Jeb Bush is rather dovish. It's been 20 years now since NAFTA was put into effect. We should be talking to our neighbours about what the next 20 years will look like. Hillary's rather hawkish. NAFTA's still controversial, but people will thank me in 20 years. I'm not sure what for, but anyway, read into that what you like. And Larry Summers with a rather more practical, it was difficult to sell NAFTA because it's difficult to see open markets, and how right he is on that point. But what I've learned is that energy is somehow transcending many of these thoughts and bipartisan views, and long may that continue in energy, not just here in the tri-country continent, but also in energy markets around the world. I'm going to say a few words on integration around LNG. It happens to be a topic of mine, it happens to be something I know a bit about, and it happens to be the core of a company that I run here in Houston. And it's common, interestingly, to all three countries, and it's a key part of the energy infrastructure developments to boot. So look, let's just sort of take the global context. We've a lot to be optimistic about, whatever we think, about our lot in energy today. Energy output doubling by the year 2040. 2 billion new customers or consumers of energy, and 3 billion people moving up into the middle class. So a lot of change ahead of us. And if you factor in energy efficiency, which ought to be a watchword for all of us in and out of the energy industry, demand's growing about 35% in real terms, measured from 2010 to 2040. That's a pretty significant growth industry to be in, particularly in these troubled times today. And I'll come on to what the consequences of that might be. Shell puts it another way. Take the US energy system today, double it, and that gives you 2035. So, a hell of a lot to play for. But we've also got these intertwined non-energy themes, which today include multiple theatres of hostility. And I think we've all been scarred by the graphic violence of conflicts and the resulting devastation. And coupled to that, this human migration of almost biblical proportions that we're seeing on a global basis, not just in Europe, but also in Asia. And the OECD economies juggling these humanitarian necessities with the economic realities of what to do. But as ever, the walls, will go up, but ultimately, as did the Berlin Wall, they will come down. And I heard some comments on that in the last panel that I was listening today. As eventually, of course, will the DMZ on the Korean Peninsula. History has shown us that this is the case, and we'd be well advised to seek some wisdom from the past. The problem doesn't go away. And of course, there are a plethora of political, macroeconomic issues, from devolution, sanctions, the distraction of presidential elections, if I may say, as a non-American, subsidies, protectionist policies, and the pressures of climate change. But our energy markets are challenged too. I mean, oil prices in the 40s, maybe the upper end of that today, but with a 12-month outlook of just in the 50s. But does that mean anything? Does the forward curve mean anything? I think I said on Monday night that the forward curve in the oil markets was as much use as a chocolate teapot. But last year, just 1 year ago, the finest analysts that we could muster had a 12-month outlook of $92 a barrel. So, go figure. Gas, of course, is traded on a worldwide basis, and it's trading today at plus or minus $7 pretty well everywhere you try and buy it, apart from here in the US where it's a hell of a lot cheaper. But it's a market which is global and not globalized, and in which liquidity derives from a product which has no traded hub, which is LNG, and we'll come on to that a little later on, one of the great curiosities. Now, it's been a roller coaster since the crash of 14. many of you will have opened your newspaper on Monday morning to Wood Mackenzie predicting doom and gloom and $1.5 trillion of projects coming out of the industry if commodity prices stay where they are today. The market capitalization of companies here in the US has gone down by 40%. I'm talking about energy in 1 year. And debt on the same basis has gone up by 35%. We've seen $27 billion in the first half of this year of debt and equity issuances. At Pinebrook, who I advise, we imagined that many of the shale plays just 1 year ago were break even at $60, and we said that slightly, holding on to the lectern. We now know that the best of these are break even in the sub-40s. How things have changed. At TPH, if we look at one of the marquee shale plays here in the US, the so-called STACK, which is a pun and is intended, we've seen an increase of 50% in productivity with a 40% reduction in costs over the same period. It speaks to the ingenuity and innovation, I think, in this industry. And the big name analysts are now redefining prices as being lower for longer, moving to lower for even longer, if you saw the thing that was put out by Jeff Curry the other day. But we've learned some other things along the way too. Firstly, that ultimately the market is going to set the price of oil. I don't care what anybody says, the market balances itself around supply and demand. Now, it can be messed around with or altered by traders and by sentiments, but ultimately supply-demand makes the market. And the fact is today we have too much supply, therefore the price of oil is too low. We are uncertain about whether the market's growing or not. Witness just 10 days ago, Goldman Sachs and the IEA putting out entirely contradictory views about the growth in oil markets on the same day, in fact, within an hour of each other. So what's changed in the year as we've seen oil price collapse and run down the roller coaster? Well, for one, fear of terror has gone away. In the energy markets. The level of global conflict hasn't brought around a nervous response. In quite the contrary. I mean, today we see ISIS as a producer and supplier of oil, and we're about to welcome back Iran. Now, TPH's view is that the energy sector is currently in a maelstrom, to use their words, of uncertainty. And what started out as a US shale problem is now a global macro supply-demand problem that encompasses a whole range of issues, and not just the ones we regularly talk about, how much shale production and what Saudi's behavior looks like on the day. But fears of US shale supply decline on the back of the speed of response when price goes up. We had the mini cycle, and what happened? Two things happened. People placed their hedges into the market as quick as they could get them in there, and secondly, they brought rigs back to work, and guess what happened? Boom, the cycle ended, and it was over oh so quickly. We're worried about higher Saudi and Iraqi and Iraq production, for that matter, and particularly in Iran, how quickly the bears are lining up with Iran to convince us that there's going to be a lot more than there probably is. Fear, perception, increasing reality perhaps of a short-term fragility in the Chinese economy. The commodity route generally, which has been smashed on the back of oil, stronger dollar, weaker Chinese currency, all real influences. And we could add to that variously Russia, Mexico, topic today, private equity war chest, cost demand. In Tudor Pickering, we have an expression for this a lot. We call it the dirty dozen. There's a lot to think about, and just to quote Tom Peters, a great, perhaps the first of the management gurus, if you're not confused, you're probably not paying attention. But on the flip side of this, we do have a gap to fill. And this notion that at $40 or $50, the world looks pretty bad, that is not the case long term. This market cannot sustain itself on $40 oil. I'm afraid the diet is too cheap. Who knows what the number is? It's north of 60. It's probably north of 70. Maybe it's $80. But we're going to have to drill a lot more, and we're going to have to bring it from more than just in the US. Now, the problem in the US, of course, is that it takes money and the industry hasn't got any anymore. Private equity does. It's got about 80 to 100 billion in the energy sector just waiting to unleash on the opportunities that will come once the Chapter 11s really start to kick in and the second half of 2015 starts to pay the piper for the first half of 2015, where I say we dodged more than one bullet. Of course, away from home, Saudis stepped up production. We've talked about that a lot. But partly to offset disruptions elsewhere. Talking to Ambassador Zherzhen a few minutes ago, certainly shoring up the Asian relationships and fast satisfying Asian customers, but also, quite simply, its own internal market. Saudi consumes a lot of oil, and 500,000 of that comes from the switch between summer air conditioning and non-summer air conditioning. And so when Saudi didn't cut in 14, the world assumed it was a market share game. And, perhaps it still is. But I think the next OPEC meeting is going to give us some real clues. And I think having used 100 billion of their resources and reserves, may bring them to heel just a little bit. We think there's an appetite for moderation, let's put it that way. Iran, maybe 500,000 barrels a day max. We think it's probably priced into the market already. And pretty much anywhere else in OPEC that you look, it's tapped out. There are problems right the way across the OPEC slate, and it's difficult to see how any of those are going to make a material difference. But then, of course, we have the IOCs, and they're stuck too. I mean, they're running out of cash. The cash flows, around 80% of cash flows are satisfying debt today, generally in the energy industry. Exploration success is looking more like over the last 3 years, exploration failure on a systemic basis. Reduced capex budgets as a result of reduced cash flows. Energy policies and politics are more difficult as governments try and shore up their own treasuries by seeking a greater piece of the pie. It all just doesn't go round, of course. It makes it all more difficult. So anyway, geopolitical and energy market factors are providing a sort of mix or a cocktail that I doubt any of us have navigated in the past. There isn't a compass or a playbook that I can think of that we can deploy that allows us to deal with the change that engulfs us. But in the market we live in here, we have the advantage of a one-continent approach to at least energy management. And you've heard a lot about this today, and it makes it easier, I think, for North America region than any of the other regions, continents, or aggregations that we look at across the world. So let's say a word or two about energy integration then, perhaps from a slightly more macro picture. Wallace Pratt, a legendary geologist from Humble Oil, an Exxon predecessor, and his tower still stands as one of the few architectural elder statesmen downtown, said, "Oil is first found in the minds of men." And it's worth remembering that it's men and women that have to find this stuff. It's not assembled on a line, but it's won from the ground. In order to find and incentivize people to get it out of the ground, we've got to provide the promise of maximizing their rewards through the markets. The market, of course, being the key word in that little soliloquy. And no greater market, in my view, exists today than the increasingly integrated North America. I mean, just by the numbers, we consume 23 million barrels a day, the largest integrated oil market in the world. The EU is 12 for reference, and China is 11. Combining Mexico, the US, and Canada, we produce about 18. But what's remarkable, though, is if we look back and see how production's changed, it's changed through innovation and not through politics. 10 years ago, we were producing just over 13. And we looked collectively to be destined for a lifetime of increased exports of oil and gas. And of course, oil is a story one forgets because there was no legacy infrastructure. But in LNG, which was the gas story, look at the relics, which are now being turned around as export facilities. Look at the capital, committed on the basis that we needed to import gas because it was trading at $12 a barrel here in this market very, very, very few seasons ago. The US has added about 5, Canada about 1. the revolution of hydraulic fracturing and shale and so on is a story we all know well, and it's changed everything. And as we now leave the market to work, whether it's for crude, refined products, natural gas, electricity, capital flows, it's important whether or not this flows through into political decision making. The US imports about 3.5 million barrels from Canada, more than any other country by a multiple of 2. And when the US lacked the infrastructure or the refineries for Bakken Light, it went to Canada, despite the US ban on oil exports, very much a topical subject today. And the Commerce Department has recently allowed swaps and exports with Pemex. In OPEC, by contrast, we have a different story. And if we take the GCC as being an approximation of a microcosm of North America, in an apples-to-apples comparison, they practice beggar-thy-neighbour policies and build LNG import terminals to source gas from far afield, despite prodigious resources often located next door. Quite the opposite of the integration and cooperation that we see here. But of course, we have anachronisms and interesting paradoxes here too. The US export ban, firmly resolute at the moment, at the same time as we may legislate an unleashing of Iranian oil onto the market. The gnashing of teeth over Keystone, yet the ever-increasing prospect that a victory for the free market might be a Pyrrhic one in this low-price commodity environment. And as I heard in the last session, the triumph of the market in the apertura in Mexico, and yet the lackluster participation from the international community for obvious reasons in the early auctions. I'm not sure how Diego Rivera would have painted this chapter in Mexican history. But all of these will be history not too long from now, and we'll continue, as we have done, to invest in, build out and celebrate the increasingly integrated infrastructure and trade, not just in NAFTA, but globally. Of course, there are some other warts on the frog. First Nations issues in Canada and the growing voice and noise of the environmental lobby here in the US. But all of that said, and negativity aside, there are 5 opportunities that lie in front of us that I want to call out. It could be more, it could be an awful lot more. Firstly, the enormous prospects offered by gas infrastructure from the US to Mexico. Now, this is moving apace. We've got active and well-bid auctions and infrastructure funds here and companies in North America actively seeking interests in these long-term rate-paying assets. And we're seeing Mexican gas trading at more or less hub, plus or minus a bit of transportation. And these will go from 2 to 5 BCF, we imagine, in the not-too-distant future. And it's important as it reverses the flows of LNG still flowing into Mexico, repowering Mexico, and also repowering the industrial economy itself. Secondly, perhaps an even bigger point, and one that's not talked about so often, the products and midstream infrastructure, which has certainly not kept up to pace with the increased importation today from the US of gasoline and diesel, and an entire replumbing of the system in Mexico is required. A huge opportunity, and products are lagging the gas infrastructure and the noise that gas is making, I would say, by some measure. Thirdly, the general topic of infrastructure integration throughout North America to facilitate the LNG exports, which are going to be a very big story. So from the Marcellus and the Utica in the north, the Horn River, Montney, down to the Veracruz Basin, there's enough gas to make Henry Hub the price-setting mechanism for the world. Fourthly, electricity markets in Mexico. Tales of alertas críticas, when the CFE would simply shut off the gas at times of peak demand, are unacceptable in a state as dependent on manufacturing as Mexico. It isn't enough just to build a gas infrastructure. We need CCGTs to handle the load, and they're an important part of the growth. Another great opportunity set in the round there. And finally, upstream. Early indices are unlikely to be the story of the constitutional change. Clearly, at today's prices, the deep water and ultra-deep water offerings would be challenged. and the security issues perhaps around the prime Burgos shale will moderating to uptake in the short run. But I can assure you the industry, to some degree, will be there in one form or another. Prices are not going to be at $40 forever, and perhaps for not very much longer too. So let me say a few words then about LNG. It's a hot topic in all three countries. And let me start, and as we think about the startup of this, which is that will be the first exports of LNG from the North American continent since the commissioning of the Kenai plants, which, by the way, is still running after 46 years. With the startup of LNG from Sabine Pass, probably in early 2016, North America is about to change, like it or not, the entire LNG wiring diagram on a global basis. And it's interesting that it's sort of creeping up on us. People sort of say to me, well, is it really happening? Is it really been built? Well, I can assure you it's not only been built, but by 2022, North America collectively will be the world's largest exporter of LNG, dwarfing Qatar and dwarfing Australia. 2022, 7 years from now, we will have changed the complexion of an entire industry, which is one of the richest hydrocarbon industries on the globe today. The trade's about 250 million tons today. That's around 12 trillion cubic feet of gas. 19 exporters, 32 importers, 440 ships. The trade was valued at about $120 billion in 2015. That is about to double. It's the second most valuable commodity after oil, just to put that into context. People talk about the short term and the long term. The short term is about 30%, give or take. Global gas grows at about 2%. I think oil demand is growing at about 1.4, depending on who you believe. LNG is growing at 4 to 5 times that. It's a remarkable growth on a global basis. This is not a narrow increment. But today, the market is in stasis. We've got low prices, and buyers and sellers don't know what to do. They don't want to leave anything on the table. They don't know whether to sell on Henry Hub, buy on oil, create a new index. Everybody is stuck. But as we know, low prices, the best cure for low prices, as we all know, is our low prices itself. So the reboot of this industry is a kind of 2020 and beyond. So in the meantime, the dial has been set. What we've set in place is what we're going to get. It's not going to change a great deal between now and then. But the battleground is 2020 to 2030. And low-cost LNG coming from North America on the back of cheap, long-term natural gas is going to be the catalyst which will change things on a global basis. Now, there are plenty of projects out there, as you all know. I'll do the math for you. The industry is 250 million tons today. It'll be 500 million tons by 2030 or 2025, depending on your degree of optimism. There are 800 million tons of projects today on the drawing board, all with names, all with people chasing them, making their living around developing those projects. But they're chasing something which is 1/4 in terms of contestable markets. We're seeing some disruption in the market. We're seeing floating LNG. We're seeing FSRUs. We're seeing mid-scale LNG, which my own company is developing, changing the complexion of the market and bringing the costs down, which of course is what this was all about. You don't need a big balance sheet to play this game anymore. It's open to many players of many types. Now, in North America, just to bring it home to the topic du jour, between 60 and 90 million tons, remember 250 is the global market today, between 60 and 90 will be produced in North America by 2022. And the global buyers have been digesting this diet of what I call fruit and nuts on the Henry Hub index, as opposed to the rather meaty diet of oil, which they used to like, and actually rather like now, but they can't buy it, which is a bit of a problem. Coupled with this, North American demand is going up dramatically. I marveled at Rich Kinder in CERAWeek last week when he was interviewed. And he said that, he thought that the 20 was now 30. So 30 is the new 20 BCF a day of new demand by 2020 now being 30 in his mind. That's an enormous impact on this market. So not just LNG, industrial growth, transportation, power generation, and all the substitution you can possibly imagine as we take this gas, which is somehow banded between $2.60 and $3 per million BTU and doesn't seem to be going anywhere from that particular point. Now, LNG projects are hard. And they're hard for all sorts of developers, and it would be as well to remind people that financing is still a key part of it, and customers need a balance sheet. It's a very difficult thing to do when it comes down to raising $5 billion for even the smallest of these things. Now, what have we got around North America? Well, we've got an interesting diversity of projects. We've got the cluster of brownfield bidirectional projects being constructed on the Gulf Coast. They're the first cabs off the rank: Sabine, Cameron, Freeport, and so on. Then we've got the East Coast projects. We've got Cove Point, Elba Island, much smaller and much less impactful. We've got this surge of mid-scale projects, and I include gratuitously our own projects in Parallax, where we're developing what we call mid-scale LNG projects. Maybe even a West Coast project, not mine, Jordan Cove. But what's important is that Jordan Cove project is predicated on pulling both US gas and gas from Canada too. Then you've got this enormous cluster of Western Canadian projects, more than I can count on any given day. Too many with total and utter lack of cooperation. Now, you might say, well, low prices, isn't the industry going to cooperate? Well, my last role in BG was trying to navigate us through the $25 billion Queensland Curtis project in Gladstone Harbour, and I can tell you the distance between our project and the one next door was actually the width of this room. So that should give you some sense of what cooperation means in the industry today, and I can tell you it hasn't changed very much. By the way, there was another one on the other side which was the same distance away. There were 3 in a row. Maybe we see that in Canada, or maybe the industry does learn from its previous lessons. I do think one of them will go. I think the cost will be extraordinary. I think it will, if you think that probably the run rate today on Australian projects in construction is probably $2,500 to $3,000 a tonne. If I tell you that mid-scale is going to be prosecuted at around $500 a tonne, so a 7-fold difference, the Western Canadian projects, with the addition of a $12 billion coastal range, if you can build it, if the First Nations will let you, pipeline, is going to make $3,000 a tonne look like a complete bargain. So, will it get built? Probably, because this is the energy industry and we do things in a muscular and rather ignorant way at times, I have to say. Now, Mexico is also in the game too, and I have to tell you, my little Parallax is also in a joint venture with Pemex, and we're looking at a little project. It's not predicated on US gas, unlike most of the redirects of the bidirectionals. It's actually predicated on domestic resources, but Mexico is going to be in the business too. We've got all sorts of ideas around the existing infrastructure. The Baja Peninsula has long been, a place where people want to do something, given its proximity, or at least its the direction in which it points versus the opportunistic markets of Asia. And then finally, I think for me, the great curiosity, which is Eastern Canada. Because everybody talks about Western Canada, and they do so because of the extra, or the reduced proximity to what they see as the prime markets. I actually think that one of the prime markets here today, and for the foreseeable future, is actually Europe. But in any event, very fewer First Nations issues. Fewer pipeline issues. You can pull gas from the US, you can pull gas from west to east across Canada on pipelines that exist and are not in service or are half empty today. Much fewer, as I said, First Nations issues, and more benign provincial governments, I would say, with somewhat less fiscal switch and bait that we've seen from their energy-rich cousins on the west. Now, who are the winners and losers as North American LNG hits the market and takes its first place by 2022? Well, first of all, I would say Russia. Russia's been able to rely on European demand to sell its gas at a price more or less of its own choosing. Low-priced LNG, a surfeit of regasification capacity. Remember, European regas capacity runs at about 25% today. The deployment of FSRUs quickly and cheaply, particularly on used hulls, is going to put an end to this. And also, although Gazprom is waking up, I think the European market is going to be a big free-for-all before too much longer. Coal. Just as the cheap North American gas provided the knockout blow for coal here, off it went to Europe. And how long and for how much longer can the EU claim leadership on climate change while allowing cheap coal to forge this almost Faustian bargain with renewables instead of gas? This energy mix is faux environmentalism, far worse than falsifying diesel emissions, and above all, unsustainable. India and China, the great opportunity, access to cheap hydrocarbons, and it's always been the great hope and the great dream. Some of the new demand in oil has been fueled by the price. The question is, where does the price stay long term? But certainly those nations will benefit enormously. The upstream producers, which get to supply the gas, that's not just in Canada, it's in the US and ultimately in the Mexican offshore sector, or when the shale sector gets moving in there as well. Leaner balance sheets will have a better understanding of doing this more economically. And I think, with Utica wells now that can break even at $1, 75 million a day, if you can imagine that, from the very best of them, some of the margins are going to look rather Qatar-esque, I think, going forward. And of course, finally, US infrastructure providers. Despite the build-out, the consensus is that we need a lot more infrastructure to move the gas around. The gas isn't moving from the Gulf to the north anymore. It's moving from the north to the Gulf, and it's also moving west to east. But the concentration of demand, the LNG demand hovers around 100 miles north, east or west of Houston. That's where the replumbing will have to come in, and that's where we will have to understand how flows of this very inelastic demand are going to change flows within the US itself. But, the supply-demand dynamic is changing across Mexico and Canada too. We've got Canadian gas coming south. We've got Mexican gas potentially been exported. We've got US coming south, and so forth. It's all much more systematic, and I think it will perhaps not be managed collectively, but it will certainly be managed in a more coordinated way with this great opportunity. And there's no doubt that North American gas, whichever way you look at it, is going to have a profound impact on the global gas markets. There is no other way of looking at that. So, ladies and gentlemen, we're living in a world where the future is hard and even harder to predict. Global problems create local knock-ons. But in spite of this, North America is a great island, and it's insulated from most of the macro-political troubles I mentioned. And whilst Mexico itself presents some security issues, their resolution and dissolution represents a different challenge to that in much of the rest of the world. But island or not, the potential for North American integrated economy is vast. It's not just a xenophobic opportunity set either. The impacts of oil exports from US tight oil and new exploration and production in and from Mexican Gulf, and ultimately eventually from Canadian oil sands exported through the Gulf, are global matters. Add to this the ascendancy that we've talked about of North American LNG, and the collective impact will be world-changing. North America has the best non-OPEC opportunity set in the world. Between the three countries, we've been gifted great geology, and whilst the energy industry in all three countries is mature, the renaissance offered by the multiple shale plays from the Montney in the north to the Burgos in the south is absolutely breathtaking. Now, I grew up in this industry working across 40 different countries and experienced many challenges, from disappointing geology to tough access to politics trumping economics to poor or non-existent regulations slowing things down to greedy and out-of-touch unions to corruption to decision-making that never came to politically motivated tax audits to continuous fiscal creep to suspect judiciaries, to middlemen, to language, and the many more things I could recant that stood in the way of the best progress we could have made. Yet here on our doorstep, we have none of that. We are replete with opportunity and a treaty which makes much of what we're trying to do borderless. The markets and resources of the tri-nation continent are complementary in so many ways. As oil and gas prices rebound, the oil and gas investment opportunities will only increase for all of us. Finally, it's important that the warts on the frog do not become the narrative itself. There is so much to play for, and energy integration is a long game, and we should play it as such. Ladies and gentlemen, thank you for your attention.
We have time for some questions. I think mics are going around, and so we will. Thank you.
Thank you very much for the very interesting presentation. Nozomu Takaoka, Consul General of Japan. And for countries like Japan, in the 20th century, we had so much concern and worries about the situation in the Middle East and the supply of oil. And your talk was very promising. So what do you think about the 21st century after 2020? So countries like Japan don't have to worry so much because LNG will replace oil for power generation and things like that. And also United States can replace Middle East as a safe supply.
Thank you. Good question. Look, I think Japan's, post 3/11, Japan went about its energy policy thinking in a very much more sophisticated way than any other economy I can think of. Japan's ability on the days following 3/11 to reduce energy demand by 15% in Tokyo in 3 weeks was remarkable through just energy efficiency and conservation. And that really has been the thematic in Japan. So in the 21st century, what do I expect? A much higher contribution from renewables. In fact, your own government just a few days ago said that by, I think, 2030, Japan would be importing 1/3 less LNG than it is today. So 80 million tons today, 1/3 less. And I think the balance of the energy economy will change. But I think specifically to your question around oil, I think, my own view is that it won't be long before exports of oil are mandated from this country one way or another. And I think that opens up a great opportunity for America to connect to the Pacific markets in a very different way than it's connected in the past. Now, that does depend to some degree on the ability to build export facilities on the West Coast, which has always been the great dream. But perhaps we build them in Mexico and import the oil through the Mexican terminals if California isn't going to play ball. But my sense is that it's a number of different things, and the outlook is tremendous for Japan.
I have a question myself. I wonder, with your experience, as you mentioned, all over the world and issues of politics, fiscal changes, etc., we are witnessing now, even before the decline in the price of oil, sort of a liberalizing wave, for example, in Latin America. Of course, Mexico is a prime example, but other countries are eager to attract investment, of course, at the wrong time because prices are low. So what is your sense on how these above-ground risks play in this price environment? And in particular, do you think will fit Mexico in the Latin America category or in the North America category in looking at these issues?
Okay, 2 questions in there. I think, it's interesting. The industry, and for those that work in the industry here, I make no apology, we are lemmings. We tend to follow each other from one cliff to another. But, right now, I would say Latin America has become quite fashionable. And, I don't just mean Mexico, and I'll come back to the Mexico question in a minute. I mean, in truth, Colombia is looking quite exciting for IOCs today. Peru has, is starting to attract some interest. I think once we see, and if we see any material change in government, and certainly its outward-looking characteristics, I think Argentina represents a great opportunity too. Bolivia, despite Evo Morales early renationalization of the contracts, actually the contracts are still some of the most, some of the best in the world if you happen to be a gas producer in Bolivia today, particularly with the Brazilian market just a pipeline away. So look, I think Latin America has actually got a big white light on it right now, and there's a lot of people looking at it, and there's a lot more interest from banks who are tooling themselves up to deal with it. But I think on the Mexican question, I think people have to look at it through a North American lens. I mean, the Gulf of Mexico is just one sea. I mean, fine, we've had very little integration so far, but I mean, that isn't going to remain. I think it's, after I have to tell you, I mean, I was so, the juxtaposition of low oil price and, the first round and, ultimately the rounds that are coming up. I mean, for Mr. Lozoya, it's a great disappointment, but he's been a great champion of this. And, I just encourage him to keep his head down and keep moving. And I do think people look at it through the North American lens. They're looking at the infrastructure connectivity. They're looking at the opportunity to bring North American ideas into Mexico. It's the same geology,
Other questions? Well, I guess with that, we say thank you. Thank you very much.